Okay, let's start. It is 4 p.m. here in Singapore. We are not at the Spark studio as we usually are. Today we are at a conference room at our own research floor. I am Tangwar Beg, Chief Economist at DBS Group Research. I'm here with Eugene Leow, our Senior Rate Strategist. Hi, Eugene.
It's good to be here.
It's good to be here. It's a novel way of doing this. Our colleagues at the Spark studio, they're setting things up. I think they have an Olympian there, and which is getting in the way of us being there.
Yes, but that makes sense.
Right. So Max Mader, who won the bronze medal at kite foiling, is actually at this moment at our studio. So we're here and he's there. He takes precedence, of course. Welcome to our August 2024 live stream. Eugene, let's talk about the great unwinding narrative that happened over the course of the last 10 working days. 8 days ago, the world was coming to an end, massive gapping in the market. The yen, I think, moved by 5% in one day. And then over the last 6-7 days, things have come back up again.
Yes, it's quite amazing, right? Because there are always two views, right? Is something seriously wrong, or is it just isolated to those pockets where trades have gotten run too far for too long, right? So,
correct.
So then the real answer will not be known for some time, and it's always reasonable to be a little bit more cautious, right? Things always stay good.
But I remember when 10-year broke below 4% in a very decisive manner, you immediately said that it had gone too far. Even if the doom and gloom narrative is true, it probably has gone a bit too far.
Yes, correct. There's so many different dynamics at play at one point, right? It's just that the unwinding took center stage. And after that, there is still some scarring. Certain parts of the market are still a bit more cautious, certain parts a bit more optimistic. As we head out to the rest of 2024, it's going to be really exciting because you also have the US elections to contend with.
Yes, we do indeed. So the way we will work today's live stream would be Eugene will talk first about the market dynamics. I'll come and talk about the elections later. But first of all, let's go to the next slide and take a look at the QR code for Pigeonhole. You can ask us questions using this QR code. And in case you can scan the QR code, you can also just go to dbs.pigeonhole.at, and there you can enter the passcode Macro August 24, and that will allow you to also ask the same questions. We will keep an eye on the questions. I have my phone with me, and we will put them up on the screen either between Eugene's session and mine, or at the very end, depending on how much time we have. So as I said earlier, the outline of today's presentation is Eugene goes first and talks about the rates picture, and after that, I'll come and talk about the U.S. elections. Eugene, all yours for the time being.
All right. So for once, I'll be going first. So I think, shall we go to the next slide, please? Right. Yeah. So I think we should go back to the first principles, right? And the most important driver for all things financial markets would be where the Fed goes from here. And if you go back to basics and what the Fed is going to look at, there would be balancing between the two mandates that they have, and that would be full employment as well as stable prices. And the Taylor rule has been something that we thought would be a very good framework that had worked for many decades, and applying it to the current context would also make sense. So although we please skip to the previous slide. Yeah, so when we talk about the Taylor rule, right, we've got to be cognizant of the regime shifts, right, between periods where inflation and growth are higher, and then the implied real rate should be higher, and periods where we are close to the zero bound, there's a lot of QE, and then the neutral rate could be much lower to where we are now. Right? The issue is that we cannot really be sure. It is an educated guess most of the time whenever we enter into a new regime, such as where we are now, where interest rates were much, much higher than what we saw in the last decade or so. So the key point in this chart is that the gray line, which is our estimate for where policy rate should be, has now come meaningfully below where the Fed funds rate, as represented by the red line, currently is at. So we are now into restrictive territory given where the US economy, the CPI, as well as the unemployment rate is. So we think that rate cuts should come soon, and our call for September so far seems to be on track. So next slide, please. Yeah, so fundamentals are one large aspect of how the markets feel, how the Fed should move. Right? The other aspect is financial stability. And in this respect, the unwinding that we saw about 10 days ago has implications. Right? So financial conditions captures a very wide range of market indicators, including credit spreads, performance of the stocks, moves in interest rates as well. So the gray line represents this. If things are going very well, sentiment is very good, then the gray line should be very high. And then if things are not going very well, for example, during the pandemic, the gray line collapses. So typically, you would see that the Fed tends to hike rates when financial conditions are very good, and they tend to do the reverse when conditions are poor. And we also have a period where the Fed is deliberately causing financial conditions to be stressed, and that's when they were hiking very aggressively, 75 basis points at a go, and pushing the Fed funds rates all the way up to 5.5%. Now, the recent collapse is fast and it is sharp. Right? So therefore, it has caught many participants by surprise. And how should we really interpret this? Is it really an isolated positioning got too overstretched in one direction, and then the unwinding just needs to be cleared out? Fundamentally, there's no real reason to be that worried. Or is there something more serious, or is this just a trigger that people start to think, oh no, maybe we should be more worried about some downside risk? And so it's probably a mixture of all these things. But we would say that the correction that we saw 10 days ago is pretty violent. Right? Next slide, please. So when we look back onto how the Fed manages the policy rates, and we talk about the Taylor rule, we should look at how the Fed sees the economy evolving. Right? So if you look at the S&P forecast that they made back in June, they were looking at an unemployment rate of about 4%. Right? So given these assumptions, and one of them is that the Fed sees the unemployment rate at about 4% by the end of the year, they will only cut once. Right? So now we have the unemployment rate at 4.3%. Right? So that is already worse than what they thought the economy would evolve, and accordingly, it makes sense for them to justify that you will need more than the one cut that they penciled in back in June. It's not just the unemployment rate that is showing some signs of weakness. If you look at the non-farm payrolls as well, the average over the last 3 months has dropped to about 170K. 170K is probably about break even, and it is a clear slowdown from what we saw over the past 1-2 years when the labor market was very, very strong. So I think the direction so far is that the labor market seems to be weakening, not very quickly, but the direction could be difficult to arrest if you get this momentum. And as we get into this stage of the economic cycle, the Fed will be putting increasing weight on the full employment part of the mandate rather than on the inflation mandate, which we saw yesterday, which is 3 consecutive months of fairly benign prints of CPI, PPI. So I think that there is a shift, and the shift has occurred. And with this shift, some easing is appropriate. Next slide, please. Hold on. Yeah, so in terms of how the market reacts, right, it tends to be fast, and it tends to swing from being overly hawkish to overly dovish. So if you look at where the chart is now, right, so the Fed shifted more hawkish in June, right, that's where the red line is. The beige line was where they were in March. And if you look at the market pricing, the dotted line, and there's a lot more being priced over the next 2 years compared to just 2-3 weeks ago. So why this change, right? Is it really justified, right? So again, let's get some things into context, right? So more than 100 basis points of cuts are priced in from now to the end of the year. And in order to get close to that kind of pricing, we'll need to have 50 basis points of cuts 25, or a bit more, or some intermediates. So we will need a fairly stressed market environment and or significant weakness in the labor market that would prompt the Fed to front load by that much. And it's not just for this year, right? So this year, pricing more than 100 basis points of cuts. But if you look out all the way out to next year, the market is looking at more than 200 basis points of cuts, right? So is this justified, right? So again, it's not clear because we have not even seen the Fed cut once, and yet the market is front loading by that much. Right? Then if you look at the financial conditions, we have recovered a fair amount. Right? We are not that stressed, but we stress enough to warrant pricing in that much caution? Again, it's not clear. So I think the market is firmly on the dovish side, but it will require the data to prove that things require the amount of easing. But right now, if the market is more sanguine, then maybe there is no need to price in that many cuts. Next slide, please. Right, so what about the 10-year yield? Right, so we bucketed into the three different areas. So strong growth, 10-year yields about 4.5% and above. Moderate, about 3.7, 3.8 to 4.5. And then slow growth recession is below that. So we did revise our forecast lower. We kept it above 4 because we are worried about the big swings. And yet it is at this point, it is not a sure thing that we will lapse into a significant slowdown or recession. Right? If the Fed reacts appropriately, the soft landing still seems to be the most likely scenario. So in which case, there might not be a need to be that pessimistic about long-term growth and then being too sanguine about long-term inflation because the structural issues are here. So we need to split between the structural issues as well as the cyclical issues. Cyclically, yes, the Fed needs to cut because things are too tight. Right? But structurally, the sticky inflation picture, I don't think that's going to change anytime soon. Right? So there's also too much of a correlation for the long end with commodity prices, which I think may be a bit misleading. And where 10-year yields that neutral should be, I think should still be around 4% unless growth expectations and sentiment really crater. Next slide, please. So we talked about levels, the front of the curve, the back of the curve. Now, what about the shape of the curve? In this cycle, the steepening has been a prolonged effect. Right? Steepening tends to be more violent, rapid. But in this case, it's very long drawn because this cycle is very different, right, from what we've seen previously. If you want to zoom into just the few months, the steepening that we saw was driven by the expectations that, hey, Trump might come in and then there would be fiscal laxness and then there will be a lot of issuances and therefore some term premium is going to kick in. Right? So in the very recent past 2 months, 3 months or so, there was the first leg. And then the next leg was driven by, oh no, things don't look that good. Maybe we should steepen the curve by bringing down the short-term rates, like 2-year rates collapse. So I think when we look further out, right, steepening is still our core view, right? And then, but we have to be aware that there are different factors driving the short end and the front end. In the front end right now, does look like it wants to push the Fed to be even more dovish. But whether this is justified or not, I think it's very difficult to say with conviction that it is required. If you look at the back end of the curve is still inverted, even though the two tends did touch par briefly over the past few weeks or so. But I think the point here is that there should be a term premium being built over time, whether it is Fed easing or whether worries about issuance come back in, or whether at some point commodity prices will again go up and then it will drive the long end up again. So I think steepening is still the play to go in the next few quarters, and that will be the case insofar as the Fed is on an easing path. Or if they switch tack for whatever reason, then we'll have to revisit this view. Right? Steepening for us is unfinished business. Next slide, please. Now, it's not just the US. If you look across the G10, more than half the G10 are in easing mode already. We have the BOE joining, and we have RBNZ joining as well. So the easing, if you look across the whole, cyclically, other than the BOJ, which still has a tightening bias, everyone is on an easing mode. Right, so the RBNZ having moved, the Fed will likely be the next one in September. RBA may not feel any urgency yet. I think they might delay all the way to next year. And the BOJ, even though it might be feeling some stresses and some scarring from the yen and the K moves, but if you look at the data coming out from Japan, they are beating quite consistently. So if that is the case, they will be balancing market volatility versus the economic need to bring policy rates towards our estimated neutral 1%, but it will be done over an extended period, right? Asia in general has not eased, but today the BSP became the first one, aside from the PBOC, to cut rates. Now, the BSP was one of the most aggressive in this cycle, and I think it makes sense that if we are getting this kind of conditions now, where the central banks in Asia are able to focus on the domestic needs, then the ones who have been most aggressive should be the first ones to start calibrating lower. Next slide, please. Yeah, so the environment currently is very benign for EM in Asia. Right? So we have lower rates from the US across the world. Right? It brings down base rates everywhere. So 10-year yields across most parts of the world just fell. The difference is just magnitude. Right? For those who are very correlated to the US, so Hong Kong, Singapore, Korea, yields have also dropped a lot. Now, there's also the added tailwind from dollar weakness. Right? The dollar has been strong for a very, very long time. Right? So for about 2 years, ever since it started hiking. But now the reversal is going in. So suddenly EMSs across the board looks very interesting. And the interest into the high yielders like Indonesia and India is probably starting to kick in. So and for these economies, domestic considerations are important. So for Indonesia, perhaps it is time for BI to think about, hey, maybe we should be cutting rates since domestic inflation is not so much of an issue. Now, for India, there will be a slightly different picture because, yes, there is the inflow coming in from the bond index inclusion, but domestically, the economy is still running pretty well. Loan growth, credit growth is fairly firm. So there might not be such a strong case to lower policy rates just yet. Right, so next slide, please. Now, actually, dig deeper into this pricing of interest rates and for the BOJ. Like the last moves for the BOJ hiked short-term rates 2.25%. 0.25% is very low if you compare to the rest of the world. But it is a minuscule step, and yet there could be significant repercussions across the rest of the world because it is compressing the interest rate differentials between Japan and the rest of the world, particularly the US. And in terms of taper, right, reducing the bond buying pace from 6 trillion yen a month to 3 trillion yen is taking place over a very, very long period, right, all the way up to first quarter of 26. So if you put these things into the global cycle, so if the BOJ wants to normalize rates, so bring short-term rates higher, it's worried about your long-term rates going up too fast, hence QE taper is slow. And we have the global interest rates coming off. That the interesting part about the JGB curve is that it will behave differently from the rest of the world. Right? If the rest of the world is going to go into easing mode, then steepening is probably the default path. But the JGB curve might see flattening pressures, especially if the BOJ gets more serious about normalization. Now, next slide, please. Yeah, so for PBOC, there's probably greater relief, right? So the PBOC is probably facing several challenges, right? One of it is to stimulate domestic demand, and at the same time, it has to balance against keeping the renminbi relatively stable, right? So inflation has not been a problem for China for a very long time, right? And with its strong position, it has managed to go against the grain, doing calibrated easing at a time when the rest of the world is hiking. All right, so it's trying to support the economy, but as the global conditions grow more favorable, it can perhaps be a bit more aggressive to try and stimulate growth, perhaps cut rates further, provide a little bit more liquidity. So the front end, you might see conditions getting a bit more flush. Now for the long end, we are a little bit more cautious because the long end yields have collapsed quite a fair bit. So in which case, it feels more like catching the right levels rather than going heavily long CGVs at this point in time. Next slide, please. So how about the relative value plays, right? So Sing versus dollar is the popular one. So Sing is traded at a sizable discount to dollar rates, and this makes sense, right? So in general, Sing rates track dollar rates very closely, and the only difference is there a large discount or is there a large premium? And where we are now, where the US and the MAS are both having tight monetary policy, then Sing rates trade at a sizable discount to the dollar rates. Now, if you extrapolate out further, right, over the next, say, 4 quarters or so, what is most likely to take place, right? So logically, then should not be further tightening, right? So the risks are asymmetric to the other side, where it is likely that the Fed will ease and the MAS would also at some point ease. So in which case, we should see this discount in Sing rates start to narrow, right? And we think this could play out over the next 1 to 2 years or so. So this could be another phenomenon that we saw, reversing some of the large moves that we saw since 2022. Next slide, please. Yeah, so this will be the takeaways and my final slide. And I think the big picture in terms of rates is that more than half of the G10 central banks are easing. The Fed will join them. The Fed is the most important, and it will join easing in September. The BOJ is the exception. It has to further normalize, but the pace will be slow because market volatility will constrain what BOJ can do. Now, EM Asia, we've gotten a breather. Well, we have significantly lower US yields, significantly lower dollar. Right? So there's leeway for Asian central banks to better prioritize the domestic needs. And we saw it today with BSP. So if you go forward, as it becomes increasingly clear after the Fed delivers the cut, other central banks across the EM, across Asia will probably follow suit. Yeah, so if you guys got any questions, next slide, please. Do go to Pigeonhole and fire off your questions over there.
Right, so let's keep that on the screen for a little while so that we are getting a lot of questions. I will put a few of them on the screen right away before my section begins, but let's just keep that there for now. Eugene, we woke up this morning to fairly favorable inflation data out of the US. I think other than housing, non-housing services, goods, core, everything looks going very much in the right direction.
Yes.
You wrote a piece about it this morning, so you want to share some of the takeaways?
Yeah, so I think the key point here is that the inflation scare that we saw in the first quarter of this year, that has dissipated.
Yes.
Right, it's just an aberration, and we are going in a period where the US is cooling off, and it is cooling off slowly so far, which is a good thing. Right? So the inflation is no longer the focus. It has been the focus from 21, 22, 23, but it is now off the radar. So for now, I think the whole priority for many central banks, including the Fed, is making sure that this recovery that they are seeing, this can be sustained, can be prolonged. So if real rates did not be that high anymore. Right? So inflation keeps falling, and then policies rates are at 5.5. You raise 2 plus, close to 3% might not make sense. Yeah.
But Eugene, so two considerations here. So we had said, even when inflation was a bit of an issue, that the Fed is likely to cut in the second half of 2024, not because they will declare victory over inflation, but they would make this point that having short-term rates at 5.5%, even if inflation is not down to 2, but say 3, is too high. Yes. Real rates are too high, so they should cut. Now, of course, they're probably going to have sub-3 inflation to deal with, so that argument will be even more convincing. But the other argument, which is keeping real rates 2.5, constitutes an excessive tightening of financial conditions. Other than that 8 days ago market sell-off, by and large, I don't see any tightness in financial conditions. Stocks are up substantially for the year. Bitcoin is up. Credit spreads are very narrow. We see no impact of QT having a issue with liquidity. So are we really talking about tightening of financial conditions in practice, or are we only talking about it in theory?
I think so far it's limited to theory.
Correct.
Right? So I think the issue here is that across the spectrum of asset classes, right? Like you said, stresses are in pockets, right? And then typically people look at credit spreads, and they have been remarkably well behaved because, but it's not showing the signal that something has gone seriously wrong, right? Because the credit moves, yes, we know we have a serious event that happened in the pandemic as well. But this time around, even though there are swings in the FX, swings in rates, swings in stocks, things are benign so far. So perhaps it's just a lot of confidence that the Fed will react to ever the worst of it, or perhaps the economy is actually doing not that badly. Right? So we can't really tell, but it doesn't look to us, right? At this point, the things are that bad.
Right. Look, I mean, we can draw a long list of things that could go wrong. We saw with Silicon Valley Bank a year and a half ago that duration issue, even for companies or banks that hold on to AAA assets, could be a big risk of mark-to-market losses. We can say that there is a huge amount of action in the private side of the market on which we don't have very good data, leveraged loan markets and so on. We can say that there are a lot of asset holders on the commercial real estate side, which is clearly not doing well, and that could be a source of risk. Maybe not a systemic risk, but a risk nonetheless. We can say that there could be global financial market volatility around U.S. elections, or a war in China or Middle East or Ukraine, wherever. Not even if it's not war, but just risk of heightened conflict. So there are many things that can go wrong. And just with this 5.5% short end, there could be financial market accidents. But financial market conditions in reality are still holding up pretty well. Substantial amount of quantitative tightening since the cycle began, now in this past the second year, have been still fairly orderly. So the system has not broken. We don't see any major signs of it breaking, but maybe you only see those things in hindsight. You don't know. So Eugene, before I start my section, let's put up a couple of questions from Pigeonhole on the screen, especially the first one. So this is on. If Fed cuts 0.25% in September and stops any cut in 2024, and if there is only 1 or 2 rate cuts, what would you reckon the market will head into? So of course, this would be under rather bullish and hawkish circumstances that we get additional evidence that inflation is not coming down, which I think is unlikely, but we perhaps get additional evidence that the labor market is not slowing at all. Wage growth, which has started to soften a bit, comes around, and maybe financial markets keep on rallying. And around that, maybe after one cut, the Fed goes into November, December, feels that with the election around should not be too political, and chooses not to cut. And then in 2025, all our fears go away, markets keep on rallying, US keeps on growing at 2.5%, and very little room for a rate cut. So when I first read this question, I felt it was a bit of an outlandish, extremely low probability question. But now that I'm reading this in real time, I don't think it's like a 5% chance. Maybe it's like a 15% scenario.
There is, the issue here is that when the market price, and when we consider it's a weighted average of all the different scenarios.
Correct.
And this is plausible, whatever that time you talked about can take place, right? So this has happened before, right? The calibrated cuts that took place in the 2010s, and as well as in 97, 98 when we had the Asian financial crisis. So So if things look like they are going okay, then there's no need to cut a lot. But there would be an adjustment in the different asset classes. For example, rates would be substantially higher than where they are now. The stocks might get a bit of stress because if rates are higher, then the discounting factor kicks in. So, and then what will happen to the US dollar on the FX space?
Correct. Right. There are some FX questions that we will look at it later. Let's look at a question related to US fiscal, Eugene. Here we go. Do you worry about runaway fiscal spending in the US? What is your view on sovereign defaults? They don't have to be connected questions because I don't think we're talking about US defaulting because they get to print the dollar. But let's just focus on the first part. Do you worry about runaway fiscal spending in the US?
I think the question is framed is there any point to worry about it in the short term? Right. So the US debt, if you look at net debt, is about 100% of GDP. Right? Gross debt is about 120. And if you look at Japan, it's about over 200% GDP, and it can be sustained for a very, very long time. The US is also a reserve currency. There's probably not going to change for some time, even if the renminbi gathers steam. Right? So I guess the issue here is that it is a worry. How is it going to manifest? Probably in term premium, which is your long end, because 120% debt to GDP is not a problem for 5 years. You can run 5-6% of GDP or even 7-8% GDP deficits, and it still would not be too much of an issue. But it could be an issue 10, 20 years out. So those need to be priced.
Right. I have a couple of thoughts on this issue. Firstly, and I heard this question recently from a couple of clients, that the U.S. Treasury seems to be very keen on issuing at the very short end of the spectrum, and they're not issuing the long end. So there are some questions. I think Nouriel Rubini has a paper on this, that there's a stealth quantitative easing going on to this thing. I don't really buy that argument. I think the U.S. Treasury does its work to be as boring and predictable as possible. Yes. I think their operating mantra is regular and predictable, that the options are regular, and you will know well in advance which part of the yield curve they're issuing, how much they're issuing. And I don't think there's been any change in that. So looking at the lumpiness of the near-term issuance is, I think, worrying too much. These were telegraphed a long time before the Fed was doing any work in terms of when it was going to stop hiking rates and when it was going to cut. These were happening independently. The Treasury, it may look like they're doing what was known as Operation Twist by the ECB and also by the Fed. I don't think they're doing anything like that. They look at the spectrum of demand, and they're saying that there's substantial demand on the short end of the spectrum. There's still ample liquidity despite the QT, and people want to park it in safe assets. And the Fed, the Treasury is giving them that option. Of course, I'm not necessarily answering the question that's on the screen, which is, do you worry about runaway fiscal spending? But I do think we need to take into cognizance some of the short-term operational aspect of U.S. fiscal management, in which we have very little worry. We think the Treasury knows what it's doing. We think there is substantial demand for AAA assets, and the Fed is not necessarily coaxing the Treasury to support its QE or anything.
Yeah, it doesn't look that way. And I think they try to manage the issuances. And right now there's too much on T-bills. I think over time they will extend duration. So I don't think that the guiding principle is to do twists. It's not like when the Fed wants to do twists, there's a great intent, right? So the Treasury is probably guided by other methods, as you mentioned.
Correct. And by the way, the average duration of U.S. government bond issuance still 6.5 years. It's not like they're all going to be short-term oriented. And I'm sort of ignoring the second part of the question on sovereign defaults, because if it is in the context of the U.S., by definition, there is not a consideration. They will do it. There will be issues. I'll give you one example from India. I remember when I used to cover India for the IMF, we used to say that the interest payment on Indian govies debt was more than India's total spending on health and education combined. So, of course, it was all rupee bond. There was no default risk. The government of India could issue as much as they wanted and fund whatever deficit they wanted, but there were inflationary implications and there were serious cost implications for the rest of the budget. So now that the U.S. is spending more than 5% of GDP on interest payment alone, over $1 trillion, and I don't think it's coming down anytime soon, it has tangible cost for other parts of the economy that is in need of spending. So that is an issue. And if I were a sovereign debt manager, I would probably see that as a reason for consideration of downgrade or something like that, but not a default risk. Okay, we will come back to, there are lots of very, very good questions. So we'll come back to all this after my section. So let's now go to the next slide and go over the issue of US election. One more slide, please. Right, 2020. Donald Trump's probability of victory as priced in by the predicted website. So actual money being placed in predicted. So I'm not going to go through electoral college. I'm not going to go through national polls, swing state polls. We'll take 1 hour to do that. And it still will not necessarily shed the light that this single line does, because this combines all the information from the market, from the polling, from the economy, and tries to come up with it, because we would like to think people who are pouring money on these bets and in aggregate would be reflecting that. This shows that through the course of 2020, remember, pandemic times, and initially when the pandemic was flaring up, the view was that this emergency itself will make people want to be very keen on continuity, and Trump's probability of victory was heading towards 60% at that point. Then Biden was campaigning vigorously. Trump was making one own goal after another. You may remember at some point in 2020, Trump even got COVID, but he was espousing the benefit of hydroxychloroquine and infrared lights. So I think all of those combined, and the fact that the country did go into a recession, although financial markets were okay, led to significant drop-off in Trump's win probability. But by the end of the election season, just the last few days, as you can see, on the eve of the 3rd of November 2020, the market was assigning 60% chance of a Trump win. The market got it completely wrong, but that's the way election probability evolves that year. Now, let's superimpose on this chart what has happened so far. So, next slide, please. This is 2024. As you can see that exactly a month ago, Eugene, 15th of July, is when Trump's probability of win hit close to 70%. And we know what has happened in the last 4 weeks since then, but this chart is absolutely remarkable in showing the change of fortune as far as the prediction markets are concerned. So as we speak today, the market is estimating about 43% chance of a Trump win. The flip side of that is not necessarily 57% of chance of Kamala Harris winning, but more like low 50s. RFK Jr. is also part of the elections in many states. So Trump versus Harris does not add up to 100, but just focus on Trump. And as you can see that where Trump's win probability now resides where basically Trump's win probability was there at the April-May part of 2024, and just about all through the election season of 2020. So we're normalizing, if you will. And short of major revelations from either side, short of major market moving or economy transforming developments, war, inflation, market mayhem, whatever, we can probably expect that this is probably going to be the state of affairs between now and November. But of course, 84 days left before the elections, many things can change, so don't bet on it. But the fact of the matter is that this is where we stand now, which is odds of Trump losing and Harris winning. Now, we're not going to make a call on that. I have been on TV saying very clearly that we think this is a 50-50 election. And you know when I was doing that? When Trump's probability by the market winning was close to 70%. And so I'm very pleased that I did that, these sort of swings will take place during an election season. Don't pay too much attention. The U.S. is a fairly divided country. There are many people on two sides of the fence who will not change their mind regardless of what happens. It will be a few swing states, few marginal swing voters. That's what will determine this election. So with that in mind, let's look at the policy planks of both Harris and Trump on a couple of critical issues. Next slide. Inflation. I don't think there is much in the Harris camp that will be termed as inflationary. I had to look hard to see where did Harris stand on cost of living issues. And there, I don't think her stance is that different from Biden. Supporting targeted relief for households, favor of tax credit for those who spend at least 30% of their income on rent and utilities, paid family leave, affordable childcare, things like that. These things don't affect inflation tomorrow or the day after. They hopefully address the cost of living crisis, which is a crisis not just in the US, for many countries in the world, by some targeted measures for those who truly need it. You can contrast that very heavily with Trump, where he clearly supports supply side measures like tax cuts, which ought to, in the medium term, be supported for more investment and more production that could lower inflation. Tariff measures in the near term could lead to a one-off jump in prices for imported products, but at the same time, you can say it boosts domestic production, which in turn lowers inflation. Controversial issue. I mean, there are people who think that these measures are not that helpful for lowering inflation, and tariff measures are certainly inflationary. I'm not going to take a very dogmatic view on this issue. These are fairly complex issues, but I can say with more confidence that the tax cuts that Trump has in mind and immigration restriction that Trump has in mind will almost certainly be inflationary. On that, I think the economics is very clear. Tax cuts boost disposable income and demand. Immigration restrictions contract supply of labor and boost inflation. I think those two we can take for sure. On income support, let's not spend too much time on this. Again, Harris has very targeted measures like, raising teacher salaries, supporting minority entrepreneurship. Trump, in this table, as you can see, proposes exempting tipped wages from taxes. Guess what? I didn't have a chance to update this table. Harris has joined the fray, and she is now also in favor of exempting tipped wages from taxes. I think it's just bad economics. Again, why do we pick one part of the economy versus the rest of the economy in terms of exempting tipped wages? And I do think this kind of encourages, again, a lot of cash transactions and tax avoidance. I don't think this is a good idea, but it seems like both are going for it. There is one more thing later on I'll show you where both are going for it, which is also as eye-popping. Next slide, please. Right. Tax and fiscal policy, there again, very strong divergence between the policies. Harris is in favor of supporting a tax agenda to make corporations and high-income households pay more. So making the tax curve more progressive, the tax code more progressive, if you will, especially for those make more than $400,000 a year, whereas those who are making less, the idea is to keep taxes flat or even, if possible, cutting them. And then some support for the low-income earners to get some tax credits. Trump is very clear. He believes in tax cuts. He's talking about cutting corporate income tax down to 15% and extending his 27 Tax Cuts and Jobs Act bill on almost like a permanent basis, making those tax cuts permanent. I think that would be substantially adding to the U.S. deficit and could, on margin, in my view, would be inflationary. On trade, you might think that there is massive daylight between the two. Actually, it's not that much. Harris is not some big free trader either. Her voting record suggests that she actually has voted against both Trans-Pacific Partnership as well as the USMCA, not necessarily on grounds of trade protection, but rather on environmental climate change grounds. Remember, she's a senator, politician from California, which is the leader in the U.S. on climate provisions. But she was against those trade bills because she felt that climate-related provisions were not strong enough. And also, the sort of things that the Biden administration has done over the last 3.5 years, I don't think Harris is out there to unroll any of that. So as far as China is concerned, tariff, tech restrictions will continue under Harris, no question. Trump is more explicit. He wants to have a ring around the U.S. economy, 10% generalized tariff, perhaps even 100% tariff on made in Mexico EVs by Chinese companies, and anything that has a made in China label on it will be subject to 60% tariff. We will spend much more time in the coming months talking about trade wars, independent of whether Harris or Trump is going elected. But in terms of these sort of numbers, there is no question about it. It will hurt U.S. consumers. It will hurt Chinese producers. No two way about it. It will probably benefit a lot of third market producers. Chinese companies themselves will probably have to move to many other places to build stuff to export to the U.S. No winner here, but then of course there'll be retaliation from China. And you do realize that companies like Apple, Starbucks, Domino's, Tesla get a large chunk of their global earnings from China. So that would likely be affected either through tariff measures, or if something so radical is going to be imposed by Trump, there might even be boycotts of American products. We can expect all of those things to happen. We've seen this playbook play out in the past as well. Next slide. Right. On US dollar, a lot of not to say as far as Harris's position is concerned, but Trump is weighing in on affecting Fed independence, on the fact that strong dollar hurts US manufacturers. So I will worry about the dollar outlook, not necessarily that it would sell off a lot under Trump, but certainly will become more volatile, I would think so. Because mind you, Trump is not very policy oriented, he's very transaction oriented. So he may say something today that sounds very bearish for the dollar, but then the target of his speech may react, and then that risk might dissipate, and that might make the dollar snap back. So that kind of volatility can be expected. Now, earlier I said that there's another area where Harris and Trump are now kind of merging in a rather strange manner. That is with respect to crypto. During the Republican convention, we saw Trump go all crypto MAGA, if you will. He said something like, if crypto is going to define the future, I want it to be mined, minted, and made in the US. And then he talked about some strategic national Bitcoin stockpile. He talked about firing SEC head Gary Gensler, who has pursued strict crypto regulation. He really went all in, and you should not be surprised if you know who is donating to the Trump campaign in a very big way. People like Peter Thiel, people like the Winklevoss brothers, people like Elon Musk, all crypto bros, if you will. And Trump is very much, speaking the song that his donors want him to sing. Now, if you go that far on one issue, I don't think there is much political goodwill to be had by going against that. And Harris, to her wisdom, is also trying to be somewhat crypto-friendly, has given signals like she wants a reset with the crypto industry and have a constructive relationship. I find it rather comical, but that is where we end. Next slide. I think that's the final slide on the Harris-Trump camp, which is on climate. Clearly, we will see Harris take the big consequential measures that Biden has taken on the Green New Deal, on Inflation Reduction Act, and maintaining that momentum. She has been opposed to fracking, but if you look at the Biden years in terms of oil production, you would think that the Republicans running the U.S. Eugene, I don't know if you know, but U.S. oil production is at an all-time high. So when we talk about the Republican talking points about Biden being anti-oil and gas industry, I think data really says that. But we do know that whether it is Biden or Harris, the desire to reduce U.S.'s dependence on fossil fuel, changing the country's energy and transmission grid toward a green infrastructure, that is very much there. And if Biden's policy is fully adopted by Harris, that will be the case. On Trump, we are discussing this on the 15th of August. 2 days ago, Trump was on Twitter Space with Elon Musk, and they did, in their 2-hour discussion, talk a little bit about green transition. And because Trump was at Elon Musk's Twitter Space and Elon Musk produces EVs, Trump didn't sound that anti-green. He did, mention that, he will help more drilling and more support of the fossil fuel industry, but at the same time, he didn't necessarily lash out at EV subsidies the way he has done in the past. All right, so that's the two camp. I don't think this is the last time we're going to be discussing these issues. Maybe in the October live stream, we can come back. And then, of course, in November, we will talk about the election results. Let's now move on and talk about the impact of the election on markets. Next slide, please. I'm just keeping an eye on the time as well. All right. So this was a publication from a couple of weeks ago. We looked at U.S. election cycles going all the way back to 1968 when Richard Nixon won election for the first time. And we took it all the way to 2020, Biden's election. And what the questions that we were asking was, can we do an event study where we can see what happens to financial variables leading to the election and subsequently after the election, when the market has priced in or taken into cognizance the actual outcome of the election. So returns 12 months prior, returns 12 months after. We have in these, 56 years, good number of Republican victories and Democratic victories, a couple of cases of impeachment going back to Nixon, and then, of course, Trump. And then we also have had issues of, two Trump presidents like Reagan in the 80s, Clinton in the 90s, Obama in the 2000s, and Bush, of course. Let's not forget that. And also a couple of one-termers like Jimmy Carter and George Bush Jr. But so we have a fairly good set of data there. And what we see, first and foremost, on the dollar, that the elections are kind of neutral as far as the dollar is concerned. Leading into the election, maybe the world focuses a lot more on the US and the dollar appreciates a little bit. But the 12 months after the elections, none of the policy passed or pursued by Republicans or Democrats lead to a stronger dollar. I thought this was interesting. So if you are a dollar bull or a dollar bear, don't worry too much about the outlook going into 2024 or 2025. Looks like it's a fairly neutral year for the dollar, regardless of Harris or Trump winning. Next slide. On the bond side, what we see is a 10-year bond, sells off a tad bit before an election when people are expecting the Republicans to win. Rallies a bit because Democrats, contrary to popular perception, tend to be actually fiscally more responsible. But then in the 12 months after, it seems like the Republicans are the one who are associated with the bond market rally, and the market is fairly neutral with respect to the Democrats. So it seems like, Eugene, just by looking at it now, that the market gets excited if the Democrat is likely to win, and then after that, they really don't care one way or the other. Whereas they fret a little bit before a Republican gets elected, but then at the end of the day, they realize there's only so much they can do as well.
Yeah, I think it's guided ultimately by the economic cycle, which overrides all these.
100%. There you go. Yeah, it's not just about elections. There are many other variables involved here. All right, let's go to the third and perhaps the final slide of this analysis, which is what happens to the S&P 500. And here we have some good news to share. Regardless of who wins, the market does very well after the elections. But if the Democrats win, oh my goodness, as you can see, massive returns. Now, of course, let's handicap this. The Democrats did win election right after the global financial crisis, and Biden did win right after the pandemic. And those 2 years, the market just went vertical, and you can blame the Republicans for tanking the markets before that, or you can just say the Democrats got lucky. But it's not just these two events. I looked at it once I saw the numbers. If you look at the Obama years, if you look at the Clinton years, they were also associated with very strong equity market performance. Okay, so as you can see, equities, really, really good under the Democrats, but even pretty good under the Republicans as well. So don't worry too much about a big market sell-off, regardless of who wins. All right, that's the bit about the U.S. election cycle. I'm going to end this discussion maybe in the next 3 or 4 minutes, talking about trade trends in the region. Trade is important for Asia. Let's go to the next slide. And there's a lot of fear that as the U.S. slows, as China sort of disappoints on the downside, that we will see a big drag in Asia because Asia is so trade dependent. Well, if you look at regional PMIs, things are not bad at all. We're talking about this 7 months of this year being characterized by substantial rise in regional PMIs, and maybe a little dip in the last month or two, but we're talking about significantly above 50, very much on the expansionary ground. And if you look at the total export numbers for the region, which includes disparate economies, including Indonesia, Malaysia, which are seeing export contraction because of lackluster commodity prices, and countries like India, which is not going through the best export cycle, and then some countries which are seeing a lot. Put it all together, you still get more than 5% return for the region. Now, if we just look at ASEAN, next slide, we see that, not as vigorous PMI numbers, a little more muted, more like 51 and 2.2 for ASEAN. But even exports are, again, growing by about 5%, not that bad. Next slide. Now, look, China and Korea. We are all concerned about China. Even the latest data that the China team has, our China team has analyzed, looks like a sort of a losing growth momentum type of a quarter in the making, the third quarter as we speak. But when we look at PMI manufacturing in China, again, still above 51 despite the recent hiccups, and exports are up close to 10% on a year-on-year basis on a 3-month moving average run rate. Now, you could argue this might be the best that China sees. That little dip in PMI manufacturing foretells weakness coming ahead. But we need to see this in conjunction with other exports data out of the region. We have July export data for some of the bellwether economies in Asia. As you can see, Korea is on this stream, looking great again. Exports are holding up nicely, up 10% on a year-on-year basis, and Korean manufacturers are feeling very good about their order book. Next slide. We will look at in the next slide, we will look at Taiwan and Vietnam. Yep, here we go. Again, manufacturing is looking good. It's picked up substantially in Taiwan. In Korea, we are looking at 52, 53 for PMI, and again, double-digit exports growth on a 3-month moving average basis. So I really don't look at Asian numbers and feel worried about the near-term softening of demand. Maybe in the U.S. we're seeing some weakening of demand, but as far as U.S.-centric manufacturers, exporters in Asia, they're still in pretty good shape. So I am not as worried about an impending slowdown if I just look at Asian trade data. It's actually looking pretty decent. All right, final thing before we go back to the questions. Next slide. There is a QR code on the screen. I urge you to scan it. It is a product of 7 months of intensive collaboration with Bain & Company and Angsana Council. From DBS, we had Hunting Chua, Radhika Rao, and Ting Ma. And yours truly working on this thing. This is a report that looks at Southeast Asia over the next decade. It also has very good analysis of the performance and drivers of growth of Southeast Asia in the last 3 decades and where we stand now, and the challenges that come from climate change, but opportunities, the challenges that come from tech war, but also opportunities for the regional electronics manufacturers, and the various drivers of investment-led growth we see in Indonesia, in Vietnam, in Singapore, in Malaysia, and so on. I think it's a good report. It's shelf life worthy. It's worthy of your time. Do look at it. And the QR code that you scan will take you to actually an Angsana Council website page, which not only will allow you to download the executive summary, the cover which is on the screen, but you will also be able to see lots of things on data visualization. All right, let's go back to Q&A. Next slide. All right, okay, we just maybe go back to the pigeonhole page, or I'll just start talking about this and put them on the screen. All right, Eugene, currency question. Since Philip is not here, you have to now put on a currency hat for me. It's attempting to connect, but it's really the top question, Eugene, on the big screen right now. So even before it gets showcased on the big screen, let's just talk about it. Everyone is talking about the unwind of the JPY carry trade, but given our own client CHF loan book, how big is a CHF carry trade? Any view, Eugene?
Well, it's probably sizable and not nowhere near the size of what we saw
I
in
agree.
yen.
Yes.
Because I think the proxy for the yen carry is just yen versus the Mexican peso. And if you look at the performance of that over the last few years, and you saw the unwinding 10 days ago, it's just a blip. Yeah. It might look very, very scary, but you look at how far that has run over the past few years. Yeah, so I don't think this carry is anywhere as close as what we saw.
Correct. I think there is even some RMB carry for banks who are lucky enough to use the CNH, CNY corridor. Those are the ones. I don't think the CHF one is that big. Japan one is the one that is still, despite the unwinding that we saw last week, still substantial, and there's more room for that unwind to happen. All right. Running out of time, let's talk very quickly about one more Fed question. Apologies, I don't think we'll be able to go through all the questions, but there's some really, really good questions. Will aggressive Fed cuts rekindle another round of yen carry trade unwind, even if BOJ stands pat? Bank data estimating percent of unwind often underestimate cross-border position and risks. I think people are going to be wary about the yen dynamic. There's lots going on in Japan as well, independent of what the Fed is about to do.
Yeah, so the divergence in policy making is not going the other way, right? So the bias for the BOJ to normalize more is strong, and the bias for the Fed to do at least some calibrated cuts is also quite strong. So the interest rate differentials is going to narrow, right? So that will happen, whether it's over 1 year, 2 years, it might be some time. And then the other part about estimating the unwind risk is that there's no single point which has all the data on all the positions.
Right.
So even if you look at futures, that's only just one segment, right? So it's very difficult to estimate. It's better to understand how far a trade has run, X% over X number of quarters, then you know the extent, how much it has unwound.
Yep.
It's not clear, then it's not as been unwound.
I fully agree. There's more action in that one. All right, last question. We have like 1 minute left. Stock market's initial reaction after the US election is usually down. 2000, 2008, except Trump's winning 2016. I don't think this is correct. When we talk about initial reaction, we're talking about 1 week, 2 weeks, 1 month, or 12 months. As you can see from our study, being long the equity market, independent of election, always pays off. So we will never advise our clients to time the US market based on election outcome. It all settles down and everybody makes money down the road. So I wouldn't worry about that. Which asset class should we advise clients to invest now at this very moment? So normally we don't tell people to invest like today and then change our mind the day after. We tend to have a very steady set of recommendations, diversified portfolio, of course, substantial exposure to the U.S. market, given that U.S. is a world leader in innovative technologies and goods and service production, but also some degree of exposure to emerging markets, just as a diversification, tool. And of course, we think that there's substantial value still in fixed income markets. Credit spreads may be narrow, but they're very good quality credit, offering substantial yield, independent of what the Fed does in terms of rate cuts, 25, 50, or 75. Those trades will remain very much in the market.
Yes. Yeah. I think elections is just one aspect out of many, many things you've got to consider. So,
That's right. That's right. Again, there were some really great other questions. Unfortunately, we're running out of time. So Eugene, thanks very much. I think this experiment worked out pretty well.
Yes. Thank you very much. Thanks to our listeners as well.
Thanks to our listeners and thanks to our colleagues at Spark Studios who pulled up the tech wizardry to keep this going. We'll see you next month. Until then, everybody, stay safe, stay healthy, take care.